Okay, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker FB, the company formerly known as Facebook, now Meta Platforms. Just give me one moment to make sure the stream is working correctly and all the settings are in place. Okay, everything looks good. So right here in front of us we have our watch list of all the companies that we've valued on the channel. As you can see with our value scores, we have anywhere from 152 as a high to negative 0.82 for the lowest valued companies, with the S&P 500 as an index value coming out at 0.62. Like I said, today we're going to be doing Facebook. I know yesterday I had a little bit of uncertainty about which company I was going to be doing today. I initially thought I might be doing Google, but kind of changed my mind to go for Facebook. The reason being is that it has frankly just dropped more after its earnings relative to valuation I had done last for them. So it's like if you compare Google and Facebook, where they pop up on these lists, it just looks like a better value to me to go for Facebook. So that is again based off of the valuation that I did last year. So we'll see what it looks like today, and if it still manages to keep a score as high as it has right now, which is 1.15, which is pretty decent. If we come down to the statistical area, you can see the average comes out to 0.62, with one standard deviation up being 1.09. So it's above one standard deviation up, which is pretty significant. So that's a pretty good score in general. But again, we'll see what it comes out to today. Okay, so as with most of our valuations, I've already done a lot of the usual prep work that I go into. They have pretty much no debt, which is pretty interesting. No like real listed debt of payables or bonds. They do have lease liabilities, which I have listed here. About $14.4 billion in lease liabilities, with a weighted average maturity of 13 years and 2.8% interest rate, which, 13.4 billion is not insignificant. So if we are counting that all together, it is a pretty large amount, but compared to their $670 billion market cap, it is pretty small. So yeah, we'll see what that percentage comes out to be, but it's only going to be like a couple of percentage points, I believe. The unlevered weighted beta that we come up for them is 1.28, which is a result of an advertising mix, which we say is just advertising and software, as well as their other revenue, which we say just kind of other, as well as software, and then Reality Labs, which is like their Oculus and Meta projects that they're working on. We're basically just calling that software plus recreation. Either way, we come up with an unlevered beta of 1.28, which probably won't be adjusted too much from that, since, like I said, they have very low leverage. With the sales of capital, though, of 3.41, advertising in general typically has a very high sales to capital ratio, and adjusted net margins is 17.76. So it's like, if you can have a sales to capital ratio like that and in margins like that, that's pretty awesome. I'm pretty sure Netflix has like double that in margins, however, and I'm pretty sure they have way significantly less in sales to capital to balance that off, though. So we'll see what it comes out to be in the most recent years. I can't remember really what it was on the last valuation. And as with a lot of these valuations that I've redone, I typically try not to look at the other valuation very much, other than what's necessary to copy some information over, to not, bias my mind on them, on my views of them as of today. So anyway, I will play the fourth quarter earnings call as I work on the numbers I've done the first year, as I typically do. Let's hear what Mr. Zuckerberg say.
Good afternoon. My name is France, and I will be your conference operator today. At this time, I would like to welcome everyone to the Meta fourth quarter and full year 2021 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during that time, please press the 1 and then the number 4 on your telephone keypad. The call will be recorded. Thank you very much. Ms. Deborah Crawford, Facebook's Vice President of Investor Relations, you may begin.
Thank you. Good afternoon and welcome to Meta's fourth quarter and full year 2021 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, Sheryl Sandberg, COO, and Dave Wehner, CFO. Before we get started, I would like to take this opportunity to remind you that our remarks today will include forward-looking statements. Actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are set forth in today's press release and in our quarterly report on Form 10-Q filed with the SEC. Any forward-looking
so you can see the reported income margin is in the 30s.
And we undertake no
adjusted looks like 50s, but we still have to do R&D capitalization, so it might be maybe 40s or something.
During this call, we may present both GAAP and non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The press release and an accompanying investor presentation are available on our website at investor.fb.com. And now I'd like to turn the call over to Mark.
Hi, everyone, and thanks for joining today. This was a solid quarter for our products and business. It was also an important one for our company. In October, we announced that Meta would be our new name, and we laid out our vision for the metaverse. And when we shared our plans to connect, I said this is not something that we're going to do on our own. The metaverse will be built by creators and developers, it will be interoperable, and it will touch many different parts of the economy. In the months since, it's been exciting to see lots of other companies share their own plans for the metaverse and how their experiences and products might show up too. And I look forward to partnering with a lot of them as we work to bring this to life together. Now, if last year was about putting a stake in the ground for where we're heading, then this year is going to be about executing. And today I'm going to discuss our 7 major investment priorities for 2022. And they're Reels, community messaging, commerce, ads, privacy, AI, and of course the metaverse. And these are the areas that we're putting a lot more talent and budget towards. But before I get to that, I want to briefly touch on our Q4 results, which I know Sheryl and Dave are going to go deeper on. I'm proud of the work that our teams did here. We shipped products, our community continued to grow, and businesses of all sizes turned to us to help them reach people. But there are 2 things that I want to call out that are having an impact on our business. The first is competition. People have a lot of choices for how they want to spend their time. And
yeah, with all the drama surrounding these earnings, I am curious to see what he actually has to say about that.
Focus on Reels is so important over the long term, as is our work to make sure that our apps are the best services out there for young adults, which I spoke about on our last call. The second area, and related to this, is that we are in the middle of a transition on our own services towards short-form video like Reels. So as more activity shifts towards this medium, we are replacing some time in newsfeed and other higher monetizing services. So as a result of both competition and this shift to short-form video, as well as our focus on serving young adults over optimizing overall engagement, we're going to continue to see some pressure on impression growth in the near term. Now I'm confident that leaning harder into these trends is the right short-term trade-off to make in order to get long-term gains. But we've made these types of transitions before with mobile feed and stories, where we took on headwinds in the near term to align with important trends over the long term. And while video has historically been slower to monetize, we believe that over time, short-form video is going to monetize more like feed or stories than like watch. So I'm optimistic that we'll get to where we need to be with Reels too. Ultimately, our continued success relies on building new products that people find valuable and enjoy using. And in a competitive marketplace, we are focused on understanding the areas that we deliver on for people and executing against this strategy. Dave is going to share more on the impacts to our business in a minute, but before we get to that, I want to discuss our investment priorities for 2022. The first one is Reels. Now, it's clear that short-form video will be an increasing part of how people consume content moving forward. And Reels is now our fastest growing content format by far. It's already the biggest contributor to engagement growth on Instagram, and it is growing very quickly on Facebook too. And as we continue to improve the tools for creators, ranking for the people watching, and as we roll out the product everywhere across the world.
Yeah, I'm not gonna lie, my bias is that I just don't understand short form content.
Looking ahead, we're investing in simplifying video across Instagram, building more great creative and monetization tools for creators, and helping more people discover and interact with relevant Reels. The next investment priority is community messaging, which is about chatting with groups of people that you have something in common with, whether that's a shared community, an interest, or experience. You know, we already run some of the world's most popular messaging platforms where people connect one-on-one or in groups with friends, family, and colleagues. And we're seeing people increasingly want to share more things in messages that they were previously maybe posted to feed. So I think the popularity that we're seeing with apps like Slack in the workplace or Discord or Telegram reflects this trend too. So we're going to help people on WhatsApp better organize their group chats and make it easier to find information for the communities that they're a part of, like parent groups or neighborhoods. And we're also building community chats on Facebook and Messenger for real-time conversations within those groups and communities. Now, I also want to call out business messaging, since it's an area where there's some real momentum here. We estimate that there are more than 1 billion users are connecting with a business account across our messaging services every week. And we're partnering with companies like Uber and Geomart to help people book a ride or have their groceries delivered right from a chat. And we're building new tools to make buying online better for people and easier to manage for businesses. And we believe that this can be an important business for us in the years to come. We're also making good progress on our broader commerce efforts. We already help a lot of businesses reach new and existing customers with personalized ads, and our commerce tools are an extension of that. It's a seamless way for people and businesses to buy and sell through our apps. And our strategy here, since introducing Shops a year and a half ago, has been to make it as easy as possible for people to make a purchase after discovering a new brand or product without having to switch over to a browser or re-enter their payment info. And Cheryl will share more about our progress here, including some of the success we saw over the holidays. Now, next up is ads. And with Apple's iOS changes and new regulation in Europe, there is a clear trend where less data is available to deliver personalized ads. But people still want to see relevant ads, and businesses still want to reach the right customers. So we're rebuilding a lot of our ads infrastructure so we can continue to grow and deliver high-quality personalized ads. Now, the next two priorities I want to discuss focus on infrastructure that underpins all of our products. The first one is privacy. And we've made huge investments in strengthening our approach to privacy, including rebuilding our privacy program and our privacy review process. And we made updates to bring greater privacy to our products, including end-to-end encrypted backups and disappearing messages on WhatsApp, and end-to-end encrypted voice and video calling on Messenger. And over the next few years, we're focused on building out a major privacy infrastructure project that will encode our privacy commitments at a deeper level of our technical foundation to make them more durable and make product development faster in this evolving environment. Now, onto AI. This is one of the areas where we've routinely seen stronger returns on our investments over time than we've expected. Advances in AI enable a lot of the experience that I've talked about so far. It enables us to deliver better ads to people while using less data. It's core to all of our safety and security work. It has meaningfully improved the relevance of Reels and overall content ranking in general, and it plays a big role in our commerce efforts. Artificial intelligence is also going to play a big role in our work to help build the metaverse. We just announced our AI research supercluster, which we think will be the world's fastest supercomputer once it is complete later this year. And this is going to enable new AI models that can learn from trillions of examples and understand hundreds of languages, which will be key for the kinds of experiences that we're building. Now, looking ahead, we're focused on further scaling our computing power and transforming our AI infrastructure through advances in foundational research, as well as improvements to data center design, networking, storage, and software. Now, the last investment priority here is the metaverse. We're focused on the foundational hardware and software that are required to build an immersive, embodied internet that enables better digital social experiences than anything that exists today. On the hardware front, we're seeing real traction with Quest 2. People have spent more than $1 billion on Quest Store content, helping virtual reality developers grow and sustain their businesses. We had a strong holiday season, and Oculus reached the top of the App Store for the first time on Christmas Day in the US. We're working towards a release of a high-end virtual reality headset later this year, and we continue to make progress developing Project Nazare, which is our first fully augmented reality glasses. Now, as for software, Horizon is core to our metaverse vision, and this is our social VR world-building experience that we recently opened to people in the US and Canada. And we've seen a number of talented creators build worlds, like a recording studio where producers collaborate, or a relaxing space to meditate. And this year, we plan to launch a version of Horizon on mobile too. So that'll bring early metaverse experiences to more surfaces beyond VR. So while the deepest and most immersive experiences are going to be in virtual reality, you're also going to be able to access these worlds from your Facebook or Instagram apps as well, and probably more over time. So this will enable us to build even richer social experiences where you can connect with friends in the metaverse, whether they're in VR or not. We're also focused on avatars, which will be how you represent yourself in Horizon and across other developers.
Right, year 5, and then we'll go through a 5-year trend.
We rolled out our Metaverse Avatars SDK to all Unity developers on Quest and Rift and Windows-based VR platforms, letting developers bring meta avatars to their own VR experiences. And we just announced an update that lets you further customize your avatar to better express yourself. And we're introducing digital clothing too, starting with an NFL partnership so you can cheer on your favorite team. You can use your avatar across Quest, Facebook, Instagram, and Messenger. So it serves as another bridge between our 2D social apps and 3D immersive virtual reality experiences. And we have a bunch of work ahead to make the avatars as expressive and high fidelity as they need to be to fully represent us and help us feel present with one another. But I am very excited for the advances that we're making here. Now, making meaningful progress across all 7 of these areas is going to improve the services that we offer today, and it will help power a more social, intuitive, and entertaining metaverse where people, businesses, and creators can all thrive. And this fully realized vision is still a ways off. And although the direction is clear, our path ahead is not yet perfectly defined. But I am pleased with the momentum and the progress that we've made so far, and I am confident that these are the right areas and investments for us to focus on going forward. 2022 is the first page of the next chapter for our company. I'm grateful for all the talented teams at Meta and our partners for executing on this important work, and of course for all of you who are on this journey with us. And now, here is Cheryl.
Thanks, Mark, and hi, everyone. Our total ad revenue in Q4 was $32.6 billion, which is up 20% year over year. The close of the year also marked the first time our business generated more than $100 billion in annual revenue. I want to congratulate our teams and thank our partners for helping us.
Yeah, we'll definitely get into the earnings deck when I cover all 10 years of their history.
Continued in Q4. But there were a number of
I definitely think the numbers are better than Wall Street's treating them.
In addition to those Mark described around competition and our shift to short-form video. We were lapping a period of strong demand in 2020 that benefited from very strong growth in online commerce, which has since slowed. Q4 was also the first holiday season after Apple's iOS changes, which have had an impact on businesses of all sizes, especially small businesses who rely on digital advertising to grow. This will continue to be a factor in 2022.
We've also heard from advertisers about other macro trends that contributed to the headwinds in Q4, including global supply chain disruptions, labor shortages, and inflationary pressures. A number of industry reports have pointed to people shopping earlier in the holiday season to avoid potential supply chain issues and shipping delays. This is in line with the behavior we saw from advertisers, many of whom front-loaded their spend earlier than usual. Mark talked about 7 areas of investment. I'd like to talk about our progress in 3 of those: ads, commerce, and messaging. First, ads. Like others in our industry, we've faced headwinds as a result of Apple's iOS changes. As we described last quarter, Apple created 2 challenges for advertisers. One is that the accuracy of our ads targeting decreased, which increased the cost of driving outcomes.
All right, I'll pause Cheryl there to go over their 5-year trend. So starting with the sales to capital ratio, as I said, the industrial expectations that we have for them of 3.41 for sales to capital and 17.76 net margin, like a lot of large players in various industries, I find that that dynamic ends up being flipped. Often I find it's like the large player has it, and you could argue that they have that situation where they've like gained a whole lot of market share and they have to defend that market share through large capital investments, and so you can perhaps say that that's exactly what Facebook is, and because of that they also have large margins relative to where the industrial average is too. So they have a really low sales to capital ratio, and before we even get up there, it is a really high net margin. But looking at their multiple, you can see that they've traded in 30s, in the teens, 30s, 20s. It's a little all over the place as far as this 5-year trend goes. With the corrected PE, only the last couple numbers are accurate because the R&D capitalization is only put through on that. But in that sense, though, if you adjust for R&D capitalization, they're currently trading at a PE of 12 right now. An unadjusted PE, a gap PE is still 17. So either way, Facebook is incredibly cheap on that basis relative to where they've typically traded in the past. Looking at their balance sheet, you can see shareholders' equity has almost doubled in the 5-year period, while their liabilities have quadrupled. That's pretty crazy to see. But obviously their assets have doubled as well. But in general, I would have said that they were underlevered in the past, far too underlevered. In fact, they're still too underlevered in an actual debt sense. Their liabilities to assets, I mean, yeah, it's still pretty light. It's not like you necessarily want to have a huge amount of that because you want equity to grow. But the point is I generally think they have too little debt, which we'll get into that when we do the debt to equity ratio after all 10 years. But returns on equity, you can see have stayed pretty strong in the 30s with a couple dip years, 2019 and 2020. The returns on invested capital basically following trend. But as you can see, there isn't that large of a difference between the two because there isn't enough leverage. So it's like, I mean, granted, with returns on invested capital like that, I guess you don't really need to lever it up to get the returns on equity high. So I guess it's it's not necessary, is what would probably be the argument that you could put to the other side. But the point is, you can get these returns on equity up to 40s and 50s if you ask me, with just a little bit more leverage. But obviously that comes with more risks. So is what it is. Looking at the free cash flow to equity over the 5-year period, they had a total of 67.7 billion in free cash flows belonging to the equity investor, and during that entire time frame they paid out 69.8 billion. So in over the entire time frame they've just overpaid slightly, but obviously they've completely tail-ended that payment with the most recent year of 44.5 billion in share repurchases. So it's really only the most recent year that they've overpaid. So I would say that that's less of a mark against them than it typically would say. Also taking a look at the adjusted net capex, which is all of their capital expenditures, including R&D adjusted capex, with all amortization and depreciation included, so that we get a total yearly figure. You can see that in general it's been accelerating with a little dip here between 2018 and 2019, but overall it's exploding upward, which is probably going to be good for their forward revenues. And then getting to the corrected net margin, as I was saying, only the most recent year is particularly accurate at this point because we still have to do the last 5 years. But either way, that puts their corrected net margin at 45% or so. Maybe even a little bit lower after we do all 10 years, might be 44 or whatever, but 45% against the sales to capital ratio of about 0.5 to 0.6. So yeah, really high net margin, but a huge amount of capital expenditures once you include R&D in order to defend those margins and to expand them. which also looking out further up the line, you can see their revenues up 37%, up 26%, up 21%, up 37%. It's like that's insane. So a lot of people are reacting to the idea that they're going to have much slower growth in the future. I mean, oh well. I mean, look at that growth. So I mean, oh no, if you have to have a high teens growth or something at some point. But obviously valuations have to take that into account. So we'll see where that falls after that. Anyway, I will continue the call and the numbers now.
The other is that measuring those outcomes became more difficult. These challenges are complex and interrelated. We're working to try and improve things. For example, by making progress in closing the underreporting gap for iOS web conversions, and by introducing tools like our aggregated events measurement solution to deliver better insights for advertisers. These efforts will help to mitigate some of the challenges, but we expect the overall targeting and measurement headwinds to moderately increase from Apple's changes and from regulatory changes in Q1 and throughout 2022. On the shift to short-form video, I want to emphasize that while we're going through a transition, we're optimistic. Right now, Reels monetizes at a lower rate than Feed and Stories, but we expect this to improve over time. We've made successful transitions before, the shift from web to mobile, and then another shift from Feed to Stories. We have a playbook here. The experience we have for monetizing stories is directly applicable, so we're not starting from scratch. We think that over the long term, this shift will be a success for us and our partners too. Second, commerce. We launched a number of new tools in Q4. We released new features like ratings, reviews, and community replies to product questions, and significantly improved checkout stability. We brought shops to groups, and we started testing live shopping for creators, an early glimpse of the immersive shopping experiences that will be possible in the metaverse. Our commerce strategy remains focused on 3 areas: continuing to be the best place for advertisers to find customers and get strong ROI, making it easier to sell on our platform, and improving the customer experience.
In general, Facebook ads are considered some of the cheapest, though they have a limited spread relative to Google, but
it's great to see businesses and consumers
small businesses do tend to prefer them.
Experiences like product tags, drops, and live shopping. A good example is The Laundress, a premium fabric care and home cleaning brand from Unilever that wanted to build awareness of a new line it developed with the musician John Mayer. In November, they launched exclusively on Instagram for 24 hours and hosted a live shopping event, a conversation between John Mayer and Laundress co-founder Lindsay Julia Boyd, where people could buy the new products as they talked about them live. The hour-long event generated more than $40,000 in sales. Overall, we're pleased with the engagement we saw with our commerce tools over the holiday season and view Q4 as a promising milestone in our multi-year journey. Third, business messaging. Our focus is on helping businesses and consumers connect. Our largest monetization effort is click-to-messaging ads, where you click on an ad in your Facebook or Instagram feed, and it opens a chat with the business in Messenger, Instagram Direct, or WhatsApp. It's a great way for businesses to drive engagement. And we've seen lots of demand from consumers who want to use our messaging apps for everyday services like utilities, financial services, education, and travel. In Q4, we expanded the types of information people can choose to receive from businesses and the format in which they can interact. We're continuing to invest in new tools to make it easier for people to help and make purchases right from a chat. More than 150 million users globally now view a business catalog on WhatsApp each month. And new features like collections on WhatsApp help businesses organize their products and make it straightforward for people to find things to buy. As we enter 2022, our focus is where it has always been, building products that help people connect and businesses grow. We're making long-term investments to evolve our business and continue to drive real value for our partners. In the coming year, we'll continue to invest in things that improve ad performance for our clients, in short-form video like Reels, and in making the commerce experience better for consumers and marketers on our platforms. As ever, I'm grateful to our partners around the world, big and small, who we learn from every day, and to our teams at Meta who work so hard to help businesses through the holiday season and beyond. Now here's Dave.
Thanks, Cheryl, and good afternoon, everyone. As we announced in October, beginning this quarter, we were reporting revenue and operating income in 2 segments, Family of Apps and Reality Labs. I will begin by discussing our consolidated results before moving to segments and ending with our outlook. All comparisons are on a year-over-year basis unless otherwise noted. We delivered solid results in the fourth quarter, ending a strong year for our business as full year 2021 total revenue grew 37% to nearly $118 billion. Q4 total revenue was $33.7 billion, up 20% or 21% on a constant currency basis. Unlike the first 3 quarters of 2021, we experienced a currency headwind in Q4, and had foreign exchange rates remained constant with Q4 of last year, total revenue would have been about $307 million higher. Q4 total expenses were $21.1 billion, up 38% compared to last year.
Restricted cash.
In terms of the specific line items, cost of revenue increased 22%, driven primarily by Reality Labs hardware costs, core infrastructure investments, and payments to partners. R&D increased 35%, driven primarily by hiring to support Family of Apps and Reality Labs, as well as increased Reality Labs R&D operating costs. Marketing and sales increased 34%, mainly driven by marketing spend and hiring. Lastly, G&A increased 107%, driven primarily by legal-related costs and employee-related costs. We added over 3,700 net new hires in Q4, the majority in technical functions. We ended the quarter with over 71,900 full-time employees, up 23% compared to last year. Fourth quarter operating income was $12.6 billion, representing a 37% operating margin. Our tax rate was 19%. Net income was $10.3 billion, or $3.67 per share. Capital expenditures, including principal payments on finance leases, were $5.5 billion, driven by investments in data centers, servers, network infrastructure, and office facilities. Free cash flow was $12.6 billion. We repurchased $19.2 billion of our Class A common stock in the fourth quarter, and we ended the quarter with $48 billion in cash and marketable securities. Moving now to our segment results. I'll begin with the Family of Apps segment. Q4 total Family of Apps revenue was $32.8 billion, up 20%. Q4 Family of Apps ad revenue.
And just look at the acceleration of that retained earnings.
Or 21% on a constant currency basis.
Yeah, that's just crazy.
On a user geography basis,
over 8xing your retained earnings in 5 years.
Rest of world, Europe, and North America grew 28%, 20%, and 15% respectively. Currency was a modest headwind in all international regions. In Q4, the total number of ad impressions served across our services increased 13%, and the average price per ad increased 6%. Impression growth was primarily driven by Asia Pacific and rest of world, while impressions in North America declined 6% year over year. On a global basis, impression growth benefited from ad load increases in user growth. This was partially offset by engagement-related headwinds as we face increased competition for people's time and a shift of engagement within our app's video services like Reels, which show fewer ads than Feed or Stories today. Pricing growth was broad-based across regions. Worldwide pricing growth slowed from the third quarter as we lapped stronger growth in the year-ago period and faced currency headwinds. Pricing was also negatively impacted.
But of course, they've also 10x their net income in 6 years, so
and measurement and targeting headwinds.
That's crazy.
Family of Apps other
That
revenue
is just
was
insane.
$155 million, down 8% due to a decline in payment revenue.
But of course, that is not indicative that they'll do the same thing over the next 6 years. So
up 35% due to higher legal-related costs, employee-related expenses, marketing infrastructure-related costs, and payments to partners. Family of Apps operating income was $15.9 billion, representing a 48% operating margin. We estimate that approximately 2.8 billion people used at least one of our Family of Apps on a daily basis in December, and that approximately 3.6 billion people used at least one on a monthly basis. Facebook daily
pretty
active
significant
users were 1.9
acquisition
billion,
here.
up 5%.
Was that Instagram?
Compared to last year.
That was Instagram.
DAUs represented approximately 66% of the 2.91 billion monthly active users in December. MAUs grew by 115 million, or 4% compared to last year. Facebook user growth was impacted by a few headwinds in the fourth quarter. In Asia Pacific and rest of world, we believe COVID resurgences during prior periods pulled forward user growth. User growth in India was also limited by an increase in data package pricing. In addition to these factors, we believe competitive services are negatively impacting growth, particularly with younger audiences. Within our Reality Labs segment, Q4 revenue was $877 million, up 22%, driven by strong Quest 2 sales during the holiday season. Reality Labs
Yeah, there appears to be a strong seasonality to their Reality Labs revenue. We'll get into that when we look at their earnings deck.
And cost of goods sold. Reality Labs operating loss was $3.3 billion in the fourth quarter. For the full year 2021, Reality
All
Labs
them
operating
Christmas
loss was
Oculuses.
$10.2 billion. Turning now to the outlook. We expect first quarter 2022 total revenue to be in the range of $27 to $29 billion, which represents 3% to 11% year-over-year growth. We expect our year-over-year growth in the first quarter to be impacted by headwinds to both impression and price growth. On the impression side, we expect continued headwinds from both increased competition for people's time and a shift of engagement within our apps towards video services like Reels, which monetize at lower rates than feeds and stories. On the pricing side, we expect growth to be negatively impacted by a few factors. First, we will lap a period in which Apple's iOS changes were not in effect, and we anticipate modestly increasing ad targeting and measurement headwinds from platform and regulatory changes. Second, we will lap a period of strong demand in the prior year, and we're hearing from advertisers that macroeconomic challenges like cost inflation and supply chain disruptions are impacting advertiser budgets.
Only 2 more years ago.
Finally, based on current exchange rates, we expect foreign currency.
And we can hop into some analysis.
In addition, as noted on previous calls,
if you're watching and you're enjoying, please like, subscribe if you're not already, and follow whichever platform you're on.
Turning now to the expense outlook. We expect 2022 total expenses to be in the range of $90 to $95 billion, updated from our prior outlook of $91 to $97 billion. Our anticipated expense growth is driven by investments in technical and product talent and infrastructure-related costs. We expect 2022 capital expenditures, including principal payments on finance leases, to be in the range of $29 to $34 billion, unchanged from our prior estimate. Our planned capital expenditures are primarily driven by investments in data centers, servers, network infrastructure, and office facilities. As we discussed previously, this range reflects a significant increase in our AI and machine learning investments, which will support a number of areas across our family of apps. While our Reality Labs products and services may require more infrastructure capacity in the future, they do not require substantial capacity today, and as a result are not a significant driver of 2022 capital expenditures. On to tax. Absent any changes to U.S. tax laws, we expect our full year 2022 tax rate to be similar to the full year 2021 rate. Separately today, we announced that our Class A common stock will begin trading on NASDAQ under the ticker symbol META in the first half of 2022. The new ticker symbol aligns with our rebranding from Facebook to Meta.
I had kind of wondered about that.
2021 was a strong year for our business.
Like when I was preparing the spreadsheet and typing FB in, I was like, man, what a waste having gotten the FB symbol just to switch name to Meta. But Meta is only 4 letters, so.
As we work to deliver new and engaging experiences for people and support the businesses and creators who rely on our services. With that, France, let's open up the call for questions.
We will now open the lines for a question and answer session. To ask a question, press 1 followed by the number 4 on your touch-tone phone. Please pick up your handset before your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And our first question is from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have 2. The first one on the Reels transition. You know, y'all talked about how you've been through other transitions in the past with mobile and stories, et cetera, and you successfully navigated through. Is there anything that's unique or more challenging about the Reels transition that makes you think it could take potentially longer to sort of scale those ad products for this format as opposed to other formats in the past? Then the second one, Dave, when you sort of talk about the headwinds around ad targeting and measurement becoming larger in the first quarter and in 2022, is there anything other than sort of year-on-year data comps there, or are you expecting other changes from a signal perspective, and maybe help us understand any further changes you expect to come on the signal loss perspective? Thanks.
Yeah, thanks, Brian. I could probably take both of those. So on Reels, I mean, I think there's a lot of the characteristic of Reels that makes it, quite similar to the transitions that we've gone through before. As in the past, when we were focused on stories, we're really focused on consumer experience and really making short-form video work effectively on both Instagram and Facebook, and we're already seeing that be the biggest driver of growth on Instagram, and it's growing very quickly on Facebook. So we're really encouraged by what we're seeing, but we're really focused on making the consumer experience right. And over time, we do think it's a format that will work effectively for advertising, and we think the experience that we have for stories will really lend itself well in the Reels format. So, we're confident in our ability to monetize over time, but right now there's, relatively few ads in Reels today. So it's definitely something that from an impression growth and monetization perspective is gonna be a headwind.
Yeah, to be fair, there was a point in time where nobody thought Facebook was going to get monetized either. So
with iOS just in general in Q4, and that was in line with our expectations and similar to the Q3 headwind. But obviously, as we go into 2022, we're going to be lapping a period in which in Q1 and Q2,
one more year,
headwinds were not in place,
and we'll do some historical analysis.
So that definitely makes for a tough comp in the first half of the year. And we believe the impact of iOS overall as a headwind on our business in 2022 is on the order of $10 billion. So it's a pretty significant headwind for our business. And we're seeing that impact in a number of verticals. E-commerce was an area where we saw a meaningful slowdown in growth in Q4, and similarly, we've seen other areas like gaming be challenged. But on e-commerce, it's quite notable that Google called out seeing strength in that very same vertical. And so given that we know that e-commerce was one of the most impacted verticals from iOS restrictions, it makes sense.
There's the last income statement.
Part of the explanation for the difference between what they were seeing and what we were seeing. And if you look at it, we believe those restrictions from Apple are designed in a way that carves out browsers from the tracking prompts Apple requires for apps. And so, what that means is that search ads, could have access to far more third-party data for measurement and optimization purposes than app-based ad platforms like ours. So, when it comes to using data, you can think of it as, it's not really apples to apples.
Add an extra column, so it stops doing that.
And as a result, we believe Google's search ad business could have benefited relative to services like ours that face a different set of restrictions from Apple. And, given that Apple continues to take
I don't know why it's being weird like that. Normally I can just line the column up, but it's being weird. Whatever.
Our next question is from Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks so much. Maybe two questions if I can. First, following up on Brian's questions about Reels, I think when we've gone through these transitions before, you've talked a little bit about what you're seeing from an engagement standpoint about Reels and how levels of engagement compared to other
all the way back to the stock issuance
perspective on the property, and what the differential might be in terms of, while it's early innings, in terms of differential of ad pricing and how you think to close that gap. Is there any willingness you're able to give us on both engagement levels or pricing differential so we can think through what the transition scope might need to be? And then Cheryl,
91 through 93, what did I do?
You talked about elements of, as we move into Q1 in the first half, some of the workaround efforts
91 and 93
we're trying to implement would start to show some efficacy. Can you give us an update on where you stand internally on workarounds and broader advertiser community acceptance of some of the workarounds on targeting and measurement as we move into the first half? Thank you.
There we go.
Sure, I can start with your first question on some of what we're seeing on engagement. Reels and short-form video overall are very engaging.
Okay.
And
there's the last cash flow statement. Now we'll do the last balance sheet.
There is, people are spending a lot more time, and I think I mentioned this in my script up front that it's growing very quickly. This is already the biggest contributor to engagement growth on
plus
Instagram.
Income tax receivable.
I think is one of the biggest contributors that we're seeing to positive engagement on Facebook.
Prepaid expenses.
But I think going back to the last question, when there was a question about what, are there any factors here that what are the similarities and differences to what we've seen in the past? The big similarity
and other
is this
assets.
is, certainly not the first time that we've gone through a major format evolution. And what these transitions have all had in common, from desktop feed to mobile feed to stories, and now to Reels,
Payables,
is in the beginning our ad system and business are not as tuned for the new format. So as the engagement in the new thing
expenses, deferred liabilities,
the old thing, it creates a near-term
long-term capital lease obligations plus long-term debt.
It's not that part. At this point now is not that big of a concern.
Liabilities.
It makes some of the stuff not as clean in the near term, but over the long term we're pretty optimistic about that. The dynamic that I think is actually a little bit different with Reels than what we've seen with stories and mobile feed in the past.
Is that everything?
Is with Reels, I would say that
looks like everything.
The teams are executing quite well, and the product is growing.
All right, not to interrupt you, Mark, but that's going to do it for us. So, taking a look down back at the sales to capital ratio, as I was saying before, you can see over the long run, it's pretty much stayed in this area. It was a little bit lower in the first few years as a public traded company. So it looks like it has definitely grown a little bit in that regard, which is pretty good to see that it hasn't instead gone the other direction. Hello. Thank you for joining us. Please like if you're enjoying the content. Subscribe, follow if you're not already. Looking at the PE ratio, as we were saying before, it was a little bit in this kind of consistent teens, 20s, 30s area for the first 5 years, but it was definitely at higher multiples previously, so it definitely grew into its size pretty solidly, though as we were saying before, as far as on an annual basis goes, it's trading at a cheaper point now than ever has previously. Also, in consideration with the R&D adjusted earnings, it's we can really look at these last 5 or 6 years for an accurate measure because these don't have accurate R&D capitalization on them. But in terms of that, it's definitely trading at the cheapest point it ever has, though obviously that's in relative point to whatever growth it has in the future. Taking a look at its balance sheet, you can see that its total assets have exploded over time, pretty much 10xing over the 10-year period, though its liabilities have more than 10x over the period. It's like, is that 12, 13, or 14x or something like that. So a little bit more than that, though as I said before, I think that they're actually under levered in terms of like actual long-term debt, and regardless of that, the fact that the liabilities have grown faster than the assets, the equity has just utterly exploded because the entire balance sheet has just exploded. So they're in pretty good shape as far as that goes. And also in terms of total cash and marketable securities, they have more than their actual debt, so their leverage barely even counts as leverage as is. So moving up into the cash flow, we can see that returns on invested capital have grown over time from being in the teens. They pushed solidly into the 20s, and now they're kind of starting to push into the upper 20s and close to the 30s. Return on equity has pushed solidly into the 30s, at least for 1 year now, which, like I said, there's not really a huge leveraging going on between these ratios. Perhaps that could be improved in the future, but either way, the returns on equity have and invested capital have only grown over time, so that's pretty good. That means that they're if they are having competitive issues, it's definitely really new, and there's definitely a long way to go before that to actually hit a huge effect on them. If you look at the overall 10-year period, the entire free cash flow to equity that they've received is $86.4 billion, and the total amount that they've paid out to their shareholders is $61.5 billion. So while we said that over the 5-year most recent period they have slightly overpaid their shareholders, though that's mostly front-ended in this 2021 year, they have not overpaid their shareholders over a 10-year period. So really they were taking from their shareholders for the first 5 years and then barely paying their shareholders for 4 years after that, and then in this most recent year they've completely decided to essentially catch up in terms of the last 5 years, though they still would have a decent way to go to catch up in terms of the entire 10-year period. So if we look at their adjusted net capex over that same period, as we said before, it had exploded pretty solidly over the 6-year period. You can see it's still growing over the 10-year period, though obviously it was a little bit slower growth in those early periods. So what that shows is that the earnings that they've managed to gain massively in the most recent years are actually being put to work. Yeah, man, who is number 2? You don't usually have more than one viewer at a time, not gonna lie. 2 on YouTube, 1 on Twitch. That's kind of awesome. Normally not a huge crowd usually going on. maybe you guys can actually talk to each other for once. Anyway, so getting into the corrected net margin, as with the all the R&D adjusted numbers, the only numbers here that are going to be particularly accurate are maybe the last 5 or 6, because the R&D capitalization effect doesn't work its way all the way through. But as I said, I was expecting to be in the mid 40s by the end of it, which compares to the 30s that they have for a GAAP net margin, which you can see that the GAAP net margin has expanded pretty solidly over time, hitting upper 30s, close to 40% before starting to kind of come back down into lower 30s over the period. So with the R&D adjusted capital, it also has started to come back down over this period, but we can't really see the full effect of what it looks like on the growth period for the period before that. Going up even further up, we can see on the revenues, we were talking about how strong the growth was over the 5-year period. Well, it's pretty much consistently been so over the entire 10-year period. Looking at 5-year CAGRs on a rolling basis, you can see what 51% to 47 to 48, 41, 36, 37, down to 33 or 34. So yeah, the revenues are starting to slow, but it's still a really high number. So I don't know whether or not the market's overreacting. We'll see after we even put some numbers in. But even if you make some pretty conservative assumptions about where they're going to go from there, I think it still has a pretty large amount of growth to go. Only question is whether or not that growth is actually going to build into the market cap that they already have. Now let's see, why is the numbers not already coming through here? Must be, oh, I know what it is. But we don't have any interest payments listed on the income statement primarily, so we have to use the listed value. Now, obviously, with all of our valuations, don't get too hung up on this number. We have put no assumptions in at this point, so still a lot to look at. We're going to come down here to take a look at the cost of equity. As I said, the debt to equity ratio is pretty negligible, pretty much 2%. It's pretty ridiculously low. So their cost of equity and their weighted average cost of capital are almost exactly the same as a result of that, because there isn't any real difference between the two. There's no real leverage to be had. So we are going to adjust the debt to equity ratio. It's going to have to, not 235%, that's a 25% is probably going to be about the max it can possibly come out to be, even under a huge collapse in their market cap scenarios. Like, even if you assume that their market cap drops by like 33 to 50% and they have to double their debt, that would still only put them at like 10% or something like that. So I don't know, maybe even 15% as a low. Okay, so let's see. We will go ahead and adjust the margin next, because that's one of the things that's keeping this number from looking like anything it ought to be. Because obviously, as I said, with an adjusted net margin of 42% for the last 3 years on average, if we assume maybe their industrial average of around 15% is a worst case scenario, while assuming maybe pushing it up to 50% is like a best case scenario, that puts a middle point of around 29%. We're probably going to heavily tilt the probabilities in their favor. So we'll work on that after we get to there. After this, we'll maybe make some revenue projections a little bit. Negative 5% is the worst case scenario, is probably, yeah, way too pessimistic. Honestly, let's see, maybe 0% for a worst case scenario, and perhaps 40% is a best case scenario. And like I said, we can tilt the probabilities to be what we want it to be a little bit. Okay, so we're gonna actually go look at their earnings deck a little bit now before we make any more major assumptions. I'm not really going to project like each of their segments out and make like specific projections about users or anything like that. We are just going to use a pretty basic set of assumptions about what we think. But taking a look at it, there's been a lot of drama about the drop in Facebook users for the first time ever or whatever in the most recent quarter. But I think that that's kind of ignoring the fact that they've had a huge amount of growth overall, and also the growth is pretty specific to one area of their business. So anyway, if we go back down, where was the thing I wanted to show? We're going to look at each of the groupings. You see the family daily active users in billions has still grown up on the total, which is all of their platforms as a whole. Which the main thing that most people were focusing on was the Facebook daily active users dropping for the first time in a major way, and most particularly in US and Canada. So that's mostly come down to a specific amount of daily usages, but I don't think that's actually going to necessarily affect their overall growth, because their ARPU has moved up enough to make it so that the revenue is dispersed between it. So you could say that yes, they have less users, but their users are actually more valuable to them, relatively speaking. And they haven't even really begun to tap into the overall profitability that's viable for some of them. So okay, so let's think about what we think probability wise. Oh, we need to make a sales capital ratio adjustment. That's one other thing. Like I said, the sales to capital ratio at 0.6 for the last 3 years. So we're probably going to want to use some sort of metric based around some sort of midpoint of 0.6 or so. Puts it to about 0.65. Let's see. So our distributed debt to equity ratio is around 7%. Probably a bit much, but are we actually helping them or hurting them with it? That's the thing. Okay, so higher debt to equity ratio actually helps them, so we will actually project downward. Okay, so our current projected returns on invested capital based off the assumption we have comes out to 28.35%. That's against the most recent 3 years of about 24 or 25. So that's not too bad, assuming that it comes down a little bit. That's based off their net margin coming down to 32% as we currently have it though. But I kind of wanted to change the probabilities. Our current expected revenue CAGR is at 18%. I'm probably going to push it to maybe around 20. We're probably going to tilt this a little bit more towards the optimistic end of things and see where that brings our net margin. That brings it to 34%. Because like what I expect to happen is I expect them to still be able to grow pretty strongly, but I expect their margins to be compressed due to the competition. I expect them to still be able to grow regardless of the competition, but to have those margins compressed. So if their most recent year is 45%, it's 42% for the 3-year average. I can see it coming down to 35 or even closer to 30% on the overall net amount. Want to tilt the probabilities more, or do I want to push the lower end of the margin scale further down? That's the question. I think I'll do that because I like the revenue where it's at, I think. So revenue around 19.9%, an expected margin of 32%. Oh, don't worry, we will be valuing Google on Monday. I know I said I might be doing that today and I ended up doing Facebook instead, but almost certainly going to do Google on Monday. So we will definitely do it. We're going to do all of the big US megatech. We always do all of them. We like to keep those valuations up to date. It's just a matter of how much time I've got. Okay, so now after we've adjusted the probabilities, that brings the expected sales capital ratio up to 6.8, which is probably a little too high. So we need to maybe adjust that a little bit further down. That brings it to 6.3. That's a little bit more reasonable. 0.61. Okay, well, maybe leave that there. Let's see. Anything else other than the default risk? I think that might be about it, and then we'll go on to the default risk. Brings the expected returns on invested capital to 26%. Okay, actually pushing the returns on invested capital up for the from the 3-year average, but down from the most recent year. That's interesting. Let's see, 32%. Okay, maybe we'll bring the worst of this down a little bit, 5.9. Yeah, we won't give them any benefit of the doubt in sales to capital ratio. I think, yeah, the only place we're really giving them the benefit of the doubt is in sales. We're actually not giving them any benefit of the doubt when it comes to net margins. We're giving them a little bit of benefit of the doubt when it comes to debt to equity, and then we're not giving them benefit of the doubt when it comes to sales capital ratio. But I don't know, maybe we'll give them a little bit. 0.61. Okay, I think that's about it. Now we'll adjust for the default risk. Basically no default risk in the most recent year. Yeah, they don't really have much default risk since the debt to equity ratio is like nothing. So yeah, conservative is always good. Always want to err on the side of safety. I'd rather miss out on opportunities than go for opportunities that are gonna kill me. Actually, I'm curious about that. 19% is the EPS number that analysts have projected out. My implied analysts growth comes out at 19%. It's interesting, but that's an EPS number for them, so that's not adjusted for any buybacks. So technically, if they do buybacks, that means I'm projecting even higher for them. All right, so that's FB, good old Meta Platforms, the company formerly known as Facebook. U.S. Treasury selling most recently at 1.916%, mature market equity risk premium of 4.86%. I come up with a discount rate for Facebook, Meta, of 8.96%. They have no dividend. They had $27.6 billion in sales 5 years ago, with $117.9 billion in the most recent year. So pretty ridiculous, 33 to 34% growth for the last 5 years. That's pretty insane. Sales to capital ratio for the last 3 years on average has been 0.59 relative to industrial expectations of 3.41. So really, really low sales to capital ratio relative to the advertising industry in general. That's partially because of how focused on tech that they are. They have returns on invested capital for the last 3 years on average of 24 to 25%, so pretty strong. And their debt to equity ratio is only 2%, so pretty non-existent, honestly. Default risk also basically non. R&D adjusted profit margins come up to 42% or so on the last 3 years on average, relative to industrial expectations of 17 to 18%. So as I said, you can see the flip here. Their industry, which is basically advertising, you would expect a really high sales to capital ratio and a impressive but not a outrageous net margin is what you would expect. And with that, typically you would expect a high beta as a result to counteract the fact that they're both high. And instead, Facebook, Meta, has a low sales to capital ratio because they have huge capital investments, mostly in R&D, as well as a really high profit margin. So they get to keep a huge amount of those revenues after they've spent a huge amount in order to get them. This gets them profit in the most recent year of $52.8 billion, and they are now currently selling after their decline at 237.09. So our future projections, we have a probability distribution that's pretty tilted towards the positive end of things, relatively speaking. And with that, we get a revenue distribution of anywhere from a worst case scenario of $117.9 billion to a best case scenario of $528.7 billion, which gets an expected value of $304.4 billion. This is revenue growth of anywhere from 0% to 35% each year for the next 5 years, and expected basis 19.94%. We have sales to capital ratio on an expected basis of 0.61, and that gets us returns on invested capital on an expected basis of 26.63%. We expect that they will increase their debt to equity ratio up to about 4 to 5%, which is actually probably us maybe doing them a favor, because if they increase in market cap, that's probably really hard for them to do. So, you know, that's me actually giving them a little bit of a benefit of the doubt as far as that goes. But as a result of that, they have basically no default risk, because they basically have no major debt to speak of as it is. The profit margins, we have a distribution of anywhere from 10% to 50%, on which I think is actually probably giving them a little bit of a benefit of the doubt on the 50% case, but it's also only on a 5% chance, so it's worth noting. On an expected basis, it comes up 32%. Again, this is an R&D capitalization adjusted profit margin. So if you're looking for a GAAP profit margin equivalent, it's probably closer to like 25% or something. Just so that anybody watching isn't confused by that. It's my personal adjusted profit margin. But either way, that comes to a profit of $105.8 billion in the 5-year forward period on an expected basis. And I have an expected present value for them of $278.29, which makes them 17% undervalued compared to the current price. We have 5-year forward value targets unadjusted for any dividends that they could choose to pay in the next 5 years, of a worst case scenario of $45.26, basically no growth whatsoever scenario, to $1,205.82, a super high growth, no competition scenario. On an expected basis, that we have a 5-year forward target of $427.31, which compared to the current price gets us an implied return of 12.5% each year for the next 5 years. So yeah, pretty decent. 268, yeah, not too far off if that's the number you got. Like I said, there are some ways where I gave them some benefit of the doubt. You could argue that I gave them a pretty generous revenue growth number. You could argue that my top end of my margin estimates is pretty generous as well, but you could also argue my bottom estimates are pretty rough too. So, you know, you can take it or leave it. But yeah, I mean, you're 268, I'm 278. It's not too far off. It's, you know, undervalued, not majorly so. It's definitely one of the better values as far as big US tech goes. Before this earnings season, my previous valuations were saying that Facebook and Amazon were the two buys basically of the FANG Plus stocks. It's like those were the ones that my valuation said were at least a little bit undervalued. None of them were screaming buys per se. Now Facebook looks like a pretty decent buy. But the point is, if you had to buy one of the biggest 10 companies, then I would have said buy Facebook and Amazon. If someone, gun to my head, buy one of the biggest companies. But anyway, short-term pricing based off of multiple regression gets a suggested price of $537. But that's partially because they have really high growth expectations and really high margins, and so if you plug those assumptions into the multiple expectations, it comes up with a really high price, just generally speaking, because obviously really high growth, high margin companies trade at high multiples, and as we said, Facebook is actually trading pretty cheap right now, so that's the way it is. My own valuation score comes with a 1.11, which like I said before this valuation, it was, what was it, 1.15 currently, so I guess I'm actually rating it slightly lower than my previous valuation, which I guess my previous fair value was 283.99, and so now my current value is 278.9. So like I said, I tried not to really even look at the other valuations. I don't even really know what margins I plugged into it or other things. But as you can see, the value hasn't really changed that much from year to year, or at least according to my measure. Other than the discount rate amount, it is worth noting it did grow by the discount rate amount approximately. But other than that, it didn't shift. So that's pretty much going to do it for us today. I will probably go and read all of this chat. I wasn't able to keep up with everything you guys said. I know you guys mentioned a couple companies in there, so I will probably jot those down and see if any of them are interesting. As you said, I do look at all suggestions that come my way on the channel. I don't necessarily value them, but I always do at least go take a look on Yahoo Finance or whatever to see if they're interesting. Please like the video and subscribe and all that if you're not already. I know most of you already subscribed, it sounds like, but anyway, share if you can too. That would be very much appreciated. As I expect, probably doing Google on Monday. Here's the companies. It's basically between Google or Amazon. I think I'm going to do Google first, as well as some of my own holdings, AbbVie, Garrett Motion, and AT&T. I know those are reporting relatively soon their 10Ks. So it's basically, those are kind of all the companies coming up in the most near future, as well as the other ones that are listed here are the ones that are kind of on my radar as far as when 10Ks come out. But yeah, probably doing Google. So as I said, I stream, generally speaking, 2 times a week, though probably 3 times a week for the next few weeks at least, around the time market closes, typically around 2 o'clock. So I will catch you all next time.